Imagine Wall Street in the mid-19th century, during the tumultuous era known as the Gilded Age. This is not the sanitized, algorithm-driven marketplace of today. It is a raw, unregulated battleground, a frontier of finance where the law is sparse and the lines between genius, ambition, and outright fraud are dangerously blurred. There is no Securities and Exchange Commission, no insider trading regulations, no digital trail of transactions. Information flows not through fiber optic cables, but through whispered rumors in smoke-filled backrooms and the rhythmic clatter of the stock ticker tape, a device that spits out a cryptic stream of numbers understandable only to the initiated. Fortunes of a scale previously unimaginable are being forged in the fires of railroad expansion and industrial consolidation, and they are being shattered with equal speed in the market panics that sweep through the nation like plagues. This is a world dominated by a new breed of titan, the speculator, the corporate raider, the robber baron. Men like Cornelius Vanderbilt, the bombastic steamship and railroad commodore, and Jay Gould, the cold, calculating strategist. And among them, moving with a unique and predatory grace, was a figure both feared and respected, a man they called Uncle Daniel. His name was Daniel Drew. Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. History remembers the great bulls of this era, the builders and the optimists who bet on the boundless growth of America. But Daniel Drew was a different breed entirely. He was one of the first and greatest of the Wall Street bears, a speculator who amassed a colossal fortune, not by celebrating the rise of American industry, but by systematically engineering and profiting from its fall. While others saw booms, he saw bubbles on the verge of bursting. While others felt the warmth of euphoria, he smelled the cold scent of weakness. His genius was not just in his perpetually bearish outlook, but in the invention and perfection of a tactic so simple in its conception, yet so devastating in its application, that its name remains a part of the financial lexicon to this day. How did a simple, crude trick from the rough-and-tumble world of cattle trading become one of the most powerful and notorious ploys in the history of high finance? The answer to that question, the origin of Daniel Drew's legendary Wall Street ploy, begins not in a corporate boardroom or a bank vault, but on a dusty, arduous cattle trail. Before he was a titan of finance, Drew was a cattle drover. This was a tough, physical, and intensely competitive business, and it was here that he honed the cunning and the cynical view of human nature that would later make him a master of the stock market. He learned early that in a transaction, one side's profit is often the other's loss, and that the rules were frequently bent by those with the audacity to do so. His most famous innovation from this period was born of a simple observation. Cattle were sold by weight. The heavier the animal on the scales at the Bull's Head Market in New York, the higher the price. With this in mind, Drew devised a brilliant, if utterly deceptive, strategy. On the final day of a long cattle drive, after the animals were exhausted and gaunt from the journey, he would provide his herd with troughs of salt licks. The salt would induce a powerful, raging thirst. Then, just moments before leading them to be weighed and sold, he would allow them to drink gallons upon gallons of water. The animals would become bloated, their bellies distended with worthless water weight. He was, in the most literal sense, selling water at the price of beef. This crude but effective tactic quickly became infamous in the cattle trade, earning the name watering the stock. For most, it was just a clever swindle, a footnote in the history of agricultural commerce. But for Daniel Drew, it was a profound economic revelation, a master key that he realized could unlock the gilded doors of Wall Street. When he transitioned from the cattle pens to the world of stock speculation, he brought this predatory mindset with him. He entered a world obsessed with the new titans of industry, the railroads. These companies were the dot-com stocks of their day, surrounded by hype, speculation, and immense capital investment. Drew, with his innate bearish cynicism, looked at the soaring stock prices and did not see progress. He saw bloated cattle, artificially inflated and ready for a fall. And he realized that the very same principle he had used on the trail could be applied, with far greater sophistication and on a far grander scale, to the shares of these great corporations. This was his moment of genius, the intellectual leap that would define his career. He saw the direct analogy. The true physical weight of his cattle was like the real tangible assets of a company, its tracks, its locomotives, its land. The water he forced them to drink was like new, unbacked shares of stock, printed and issued without any corresponding increase in the company's real assets. He understood that a share of stock was merely a piece of paper, its price determined by the volatile forces of supply and demand. If he could find a way to secretly and suddenly increase the supply of a company's shares, he could dilute the value of every other share in existence, just as adding water to a cask of milk dilutes its quality. This realization was perfectly suited to his bearish instincts. By massively increasing the supply of a stock, he could trigger a collapse in its price. If he could short the stock beforehand, betting on its decline, he stood to make a fortune from the panic he himself had engineered. The practice of watering the stock was no longer about physical water. It was about diluting capital, and Daniel Drew was about to become its greatest practitioner. This ability to see profound parallels between the real, physical economy and the abstract world of stocks, to think like a cunning, calculating speculator operating outside the conventional bounds of morality, is the trait that unites all great market operators. The journey into the mind of such a figure, with all of their calculations, their psychological pressures, their triumphs, and their failures, is best described in one legendary book. This entire journey, with all its psychological depth, is masterfully chronicled in Edwin Lefebvre's Reminiscences of a Stock Operator, which is presented as a fictionalized biography of Livermore. It is arguably the most important book ever written on trading, and its central theme is the brutal but necessary education in managing risk. For those who are committed to a deeper, more methodical study of these principles, we highly recommend the edition that features a unique, detailed chapter-by-chapter analysis by Max Davidson, an interpretation specifically designed to translate this century-old wisdom for the modern reader. A link to this essential edition has been provided for you in the description below. Having discovered and conceptualized the powerful weapon of watered stock, Daniel Drew now required a battlefield on which to deploy it. He found it in the notoriously corrupt and financially troubled Erie Railroad. The Erie was a vital artery of commerce, but it was also a wounded beast, perpetually mismanaged and plagued by debt, making it the perfect playground for the great speculators of the Gilded Age. Drew, through his cunning and financial muscle, had maneuvered himself onto its board of directors and, crucially, into the position of company treasurer. He was the fox placed in charge of the hen house, a position that gave him unparalleled access to the company's finances and, most importantly, its stock certificate printing press. The stage was set for one of the most epic and brutal financial conflicts in American history, the Erie War. And the antagonist in this drama was a man whose ambition and power were as vast as Drew's cunning was deep, Cornelius Commodore Vanderbilt. The Commodore was the titan of the age, the ultimate bull. Having built an empire in shipping, he had turned his attention to railroads, seeking to consolidate and control every major rail line that entered New York City. By the late 1860s, he had conquered nearly all of them, leaving only the Erie outside his grasp. For Vanderbilt, the Erie was the final irritating piece of the puzzle. His plan was simple, direct, and backed by a seemingly bottomless fortune. He would launch a hostile takeover. He would go onto the open market and, through his army of brokers, buy every single share of Erie stock available until he had amassed a controlling interest. This was the classic corner, a brute force strategy of overwhelming the market with sheer buying power. For Daniel Drew, this was a declaration of war on two fronts. Not only was he at risk of losing his personal piggy bank, the Erie Railroad, but Vanderbilt's aggressive buying was also causing the stock price to skyrocket. This was a disaster for Drew, who, as a perpetual bear, held a massive short position on the company he himself directed. The Commodore's buying spree was creating a devastating squeeze, and Drew was bleeding millions with every tick upwards. He was trapped. He could not possibly outbuy the Commodore, whose wealth far exceeded his own. He needed a different kind of weapon. He needed to make water. This is where Drew, along with his two new, even more audacious allies, the cold, brilliant strategist Jay Gould and the flamboyant, charismatic showman Jim Fisk, formed what would become known as the Erie Ring. Their counterattack was as ingenious as it was illegal. As Vanderbilt's brokers swept the floor of the New York Stock Exchange, buying up block after block of Erie shares, the Erie Ring convened in the basement of the company's headquarters on West Street. There they put their secret weapon to work, a printing press. As treasurer, Drew had the authority to issue new stock, specifically through a loophole involving convertible bonds. With Gould and Fisk's enthusiastic support, he began to print thousands upon thousands of new unauthorized Erie stock certificates. It was watering the stock on an industrial, almost unimaginable scale. As fast as Vanderbilt could buy the shares, the Erie Ring could print them. The Commodore thought he was buying control of a company with a fixed number of shares, but he was unknowingly trying to corner a phantom. He was pouring his vast fortune into a bottomless pit, buying freshly printed, worthless paper that Drew, Gould, and Fisk were creating out of thin air. The more he bought, the more they printed, diluting his stake and draining his cash reserves with every transaction. The scheme reached its climax when Vanderbilt's bought and paid for judges in New York issued arrest warrants for the entire Erie Ring on charges of fraud. Warned by a tip-off, Drew, Gould, and Fisk orchestrated a dramatic nighttime escape. They frantically packed suitcases with millions of dollars in cash, stuffed the corporate ledgers and stock certificates into their coats, and fled across the Hudson River by ferry to the safety of New Jersey. There they established a headquarters in exile in a Jersey City hotel, which they promptly barricaded and protected with a small army of armed guards, christening it Fort Taylor. The battle now shifted from Wall Street to the political arena of the state capital in Albany. Both sides dispatched agents laden with cash to bribe the members of the New York State Legislature. It was a sordid spectacle of corruption, with Vanderbilt trying to keep his fraudulent stock issuance illegal and the Erie Ring trying to make it legal. In the end, the cunning of the Erie Ring prevailed. They outbribed the Commodore, and a bill was passed that retroactively legalized their massive issuance of watered stock. Vanderbilt was defeated. He had been outmaneuvered, his fortune diminished, and he was forced to settle with Drew and his allies. The Great Bear had not only survived the squeeze, but had emerged victorious through an act of unprecedented market manipulation. These large-scale, coordinated actions by insiders aimed at deceiving the market and individual investors are precisely what Richard Wyckoff called the actions of the composite operator. He dedicated his career to developing a method that allows one to read the tracks of such manipulations on the chart, to see the signs of accumulation and distribution that reveal the true intentions of the market's largest players. For those who wish to truly master the lessons discussed here, it is essential to study them from the source. Please take note of a unique new edition of Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds, by Max Davidson. It has been meticulously adapted for the modern trader, with complete explanations that make Wyckoff's timeless wisdom more accessible than ever. For anyone who wants to truly absorb the lessons we are discussing, this adapted edition is an indispensable part of your library. The link to this book is located in the description of this video. Having vanquished the great Commodore Vanderbilt, the Erie Ring stood as the undisputed masters of their railroad empire. Their victory, bought with deceit and corruption, was the talk of Wall Street. But the alliance, forged in shared avarice, was inherently unstable. It was a partnership of predators, and in such a world, loyalty is a fleeting commodity. Daniel Drew, the old master of financial deception, was about to be outwitted by his own apprentice, a man who had studied his methods and perfected them with a cold, unemotional ruthlessness that even Drew could not match. Jay Gould. Gould saw the market differently than Drew. While Drew was a master of the single powerful ploy, the bear raid, the watered stock, Gould was a grand strategist. He saw the entire chessboard, and he viewed his partners not as allies but as temporary tools to be discarded when they were no longer useful. He saw Drew, with his loud religiosity and comparatively simple tactics, as a relic of a bygone era. While Drew was busy trying to manipulate the day-to-day fluctuations of Erie stock for his own short-selling profits, Gould was quietly consolidating real power, securing control over the railroad's operations and planning for a future that did not include his old mentor. The stage was set for the final brutal act of Drew's career. True to his nature as the Great Bear, Drew continued to bet heavily against the stock of the very company he helped direct, holding a massive short position in Erie. He likely believed that his control as treasurer and his alliance with Gould gave him a permanent edge. He failed to see that the game had changed. Gould, who knew the exact size and nature of Drew's position, saw the ultimate opportunity, not just to make a profit, but to eliminate a rival and seize his fortune. Working secretly with his own syndicate, Gould began to meticulously lay a trap. He knew that to crush a short seller, you must take away his ability to buy back the shares he has borrowed. Gould and his partners began to quietly buy up every available share of Erie stock on the market. They bought common stock, they bought convertible bonds, they bought call options. Slowly, methodically, they cornered the market, gaining control over the entire floating supply of the company's shares. Once the trap was set, they sprung it. Gould and his allies began to aggressively bid up the price of Erie stock. The price exploded upwards in a violent rally. For Daniel Drew, this was the beginning of the end. He was caught in a catastrophic short squeeze. Every dollar the stock rose cost him a fortune, and he was legally obligated to close his position by buying back the shares. But when his brokers went into the market to buy, they found there were no shares available at any reasonable price. Gould and his syndicate owned them all. The old master was caught in a snare of his own design. The famous phrase he had so often preached to others now echoed as his own death sentence. He who sells what isn't his'n must buy it back or go to prison. Jay Gould could now name his price, and Drew had no choice but to pay. He was forced to liquidate his positions at ruinous, artificially inflated prices, transferring the bulk of his vast fortune directly into the pockets of his former partner. This crippling blow left Drew weakened and exposed. When the Great Panic of 1873 swept through the nation, a systemic crisis that destroyed even healthy fortunes, Drew had no reserves left to weather the storm. The Great Bear, the man who had profited from so many panics before, was now just another one of its victims. He was forced to declare bankruptcy, listing debts of over $1 million and assets of only a few hundred. The man who once brought Wall Street to its knees with his cunning and capital died in 1879 in relative poverty and obscurity, a forgotten titan of a bygone age. The story of Daniel Drew illustrates a market driven by chaos, greed, and brute force. It is a world where one predator devours another. But is there order in this chaos? There were those who believed that the market obeys not only the will of powerful men, but also universal mathematical laws and the immutable cycles of time. To answer that question, we're launching William Gann Trading Insights, a dedicated channel designed to be a complete ground-up resource for studying his methods. It serves serious beginners who want a correct foundation in market structure and experienced traders looking to add the time dimension to their analysis. We will systematically build a comprehensive end-to-end understanding of his methodology. Find the link in the video description. What, then, is the legacy of Daniel Drew? It is easy to dismiss him as a mere swindler, a relic of a corrupt and unregulated era, but to do so is to miss the more profound lesson. He was not just a common fraud. He was a ruthless innovator who understood the mechanics of corporate finance and the psychology of speculation better than almost anyone of his time. He did not break the rules. In his era, There were very few rules to break. Instead, he exposed the system's deepest vulnerabilities and exploited them with masterful precision. The very concept of watered stock became a central scandal of the Gilded Age, forcing a public reckoning that eventually led to the regulations that govern modern markets. His story is a collection of timeless and brutal lessons. It is a stark warning about the immense risks of short selling. It is a cautionary tale about the dangers of overconfidence and the failure to adapt as the master of one great trick was undone by a more sophisticated strategist. And above all, it is a lesson in the fundamental nature of a predatory market. There is no loyalty, and there is always a bigger, hungrier shark in the water.